Good morning. Welcome to ARK Insights. Today is July the 17th. We're pre-market. It's been a bad week, let's be honest. And I'm not talking about the stock market, actually. England lost 2-1 to Argentina, having been one goal up after 60 minutes. And then they just went into the defense mode and let Argentina score 2 goals in the last 10 minutes of the game. So it was pretty disappointing, really. We've seen this pattern again and again since the Euro final against Italy, then against Spain, and then semi-final in the World Cup against Croatia. Is just another painful tournament. Having vented that out, let's get on with the markets. So this week we have seen the latest CPI print, and of course it was an important signal because the war had officially ended last month, even though we are cancelling the ceasefire again now. But the oil prices had dropped before the recent pickup. So we're seeing a reversal of the headline CPI downwards. Is the Fed relieved? Yes. Are they celebrating? I doubt it. So we're still at this level where we are in the mid threes. That was seen in October, in late 2023. So I think until we really get CPI down to the low 2% level, the Fed is not really gonna shift their focus away from inflation. They really want to get this last mile home and get back to 2% inflation. That's pretty evident from the last FMC meeting, as well as the press conference. The good thing is core CPI has also reversed. So 2.6, not far away from what we had last year, marginally above the lows of 2.5. I think this could be a very important advanced signal if we can get down to the 2.2% first for the core CPI. That's less influenced by the price movements of oil. So since the CPI, the market has retreated some of its hawkish bets, but still we're looking at a 4% yield for the Fed funds rates in a year's time, which the market is pricing right now. So compared to today's 3.63, that's almost 40 basis points higher. And by the year end, the market still sees a full hike being in place. And if they do execute a hike, I think it's most likely to be in Q4, although there are still powerful arguments for the Fed to just keep on pausing first, just in case the labor market rolls over. Looking at the past 1 week returns, we can see that SPY is basically flat, the S&P 500, but QQQ, the Nasdaq 100, has suffered badly. It's still falling in the pre-market today. So this was 1 week as of Thursday, end of day close. But you can already see that technology and semiconductor sectors have been heavily impacted. They were previously on a really sharp rise after the initial ceasefire in April. So a lot of that is people taking profits, and there could be some people coming in to short the market as well because of how extended those names have been. So now just zooming a bit on the individual stocks, the Max 7 cohort has done okay as a whole, except for Tesla. Apple has been the best performer. We've seen Meta making a big bounce after announcing the new cloud business, trying to rent out the spare compute, and some announcement around the new frontier models. We also saw software probably bouncing back as well, and that's a factor of rotation from semiconductors into software companies. We've seen that across the SaaS companies as well. And if you look at the AI pick and shovel trade, they're all doing pretty badly in the past week. So actually Broadcom is probably the least affected. ARM is down 20%, Marvel down 22%, Micron, which is the hottest company of Q2, has also retreated from its highs significantly. There's another chart coming up as well. And generally, if you're looking at the infrastructure trade, the hot companies, Iron and Nebius, CoreWeave, they're all seeing investors fleeing out of them. So in the past month, I've started a new type of technical analysis, which is now a standalone service. And what I do for every piece of analysis is I'll have a very firm view on whether I'm overweight, underweight, or neutral, with a description of what the trend, the price pattern is. And I keep a track record of them. So in 6 months' time, we can review what my hit rate is, and what I've got right and wrong, and it keeps us on track. So if there's something that we're missing significantly in our analysis, just keeping the score is the quickest way to spot those weaknesses. So what I've seen is that for equity indices, we have been in a very range-bound fashion. So there's a lot of mean reversion without a clear momentum on the upside. But at the same time, the price is not breaking down. So I'm quite neutral on them. But for a lot of the semiconductor play, I've marked Micron as being exhausted. But when I did an analysis on Tuesday, the price hadn't broken down completely, so I was neutral. But there were already a few names that had broken their uptrends, and there are obvious new downtrends, in which case I became underweight on them. And I was more bearish towards the likes of CRWV and BIS, Iron, and based on the chart technicals I have seen. So a lot of neutral and underweight among the semiconductor and AI plays in this week. And so today's and the past couple of days stock market downfall is really not a surprise to us. And a new piece of analysis I've added. So the techniques are not really new. I've used them before and I've shown it in the last video, but I have added them onto our weekly newsletter. So we're using cycles analysis, which detects the repeatable patterns from the 5-year history of a particular of the individual stocks or ETFs. And this is just to see if there are any cyclical patterns for a particular name. And we're combining the top 3 cyclical patterns, the top 3 cycles together, which forms the orange chart here. So the navy blue line is the price, the orange is the cycles, and the 3 of them combine to form this shape. And then the shaded area here is the projection. So if we were to follow this cycle, how could the price behave? So I must warn that this is an observation. I don't use it as a standalone buy or sell signal, but they are pretty effective in combination with technical analysis and systematic analysis that I perform. And what I observe is that the equity indices have gone past the recent cyclical peak. So you can see they all peaked around the past couple of months. And now they could be entering a period of headwinds. So it doesn't mean for sure they will collapse, but in terms of a cyclical point of view, the prices will find it more difficult to go parabolic or go strongly up in the next 3 months, according to this, the past 5-year cycles. And also looking at the Max 7s, most of the Max 7s are also either peaking, which means they are just around or past the cycle tops, or they're already in a downtrend. With the only exception of Meta, but if you look at Meta, it's also in a downtrend, but just in the very near term, there's a slight uptick in the combined cycles, which is why it's called an upcycle. But otherwise, the shapes look quite similar together. And then looking at the semiconductor names, what you can see is that apart from ARM, which apparently is still in an upcycle, but I would warn that because it's a new IPO name, it doesn't really have a lot of history for analysis. So there's a warning for short price history. So if you ignore ARM here, because it's less reliable, all the other names are either peaking or already entering a down cycle. So again, the next 3 months, going to October, the rallies we have seen in Q2 is unlikely repeatable. And I track 80 names for our technical analysis. And for all of them, we can see that the great majority of the names we track are either peaking or in a down cycle. There's only 15 names that are in an up cycle. And if you exclude Meta and ARM that I just talked about, that's just 13 left. So very thin pickings. Interestingly, the 4 names that are in the trough, so they're in the bottoming phase of the cycle. 2 of them are crypto, so Bitcoin and ETH. So potentially there could be some sort of rotation into ETH, and a lot of the upcycle names are in the software companies. So there could be rotation out of big tech and semiconductor, etc., moving into the downbeat names of SaaS and crypto in the next 3 months. I have shown this chart before. So this is a chart comparing today's Micron price behavior, which had been parabolic. So this is a log chart, so it doesn't look as parabolic, but it's still a steep climb for Micron to have gone from basically somewhere below 100 to 1,100 in such a short span of period. And I have brought the good old chart from ARK just post-COVID. So ARK post-COVID also saw reap the benefit of a zero interest rate floor. And we saw that a lot of growth stocks and high beta names climbed relentlessly in 2020 and 2021. And ARK was a massive beneficiary of that QE operation and fiscal expansion. So, but if you look at how ARK has behaved since, we're still not back to this high 5 years later. And astonishingly, Micron's climb in the past year has really mimicked how ARK had peaked the year before its cycle top. And then the gray line here is silver, and the silver went parabolic in a slightly shorter space of time, and it has contracted a bit more sharply. But if Micron was to follow ARK, you can see how this plays out. And so these are just 2 examples we've picked out, and these are 2 very liquid names as well. So they're not like small pump and dump names. One, I think this comparison is pretty valid. Back on 29th of May, I warned that this time may not be different, even though everyone's talking about the paradigm shift, the prolonged AI capex spend, the memory bottleneck, and the low forward PE for Micron. But you've got to bear in mind that because of the bottleneck, everyone's trying to expand their capacity, and the price rises of DRAMs and even the HBMs, they could be just temporary. So with capacity expansion, and the demand might not actually meet the expected demand, so that demand could fall off as well. So the low PE could just be a mirage when you, if you have your DRAM price, let's say, cut in half, etc., then suddenly your PE is not as attractive as they seem to be. So now let's get on to the actual chart analysis. We are going to start with SPY. So for a while, I've had a suspicion that we're in a range-bound regime after topping out at the beginning of June. And for the past 2 months, really, we have just been moving in sideways here unable to break above the June 1st high. And what I see here is that we saw two equal length sell-offs, so S1B and S1A were basically the same length in terms of percentage. And I'm a little bit concerned that we could have S1C here as well. So if we can't break above this, then the path of least resistance is trying to mean revert. This is especially true if we can't get a broad rally that's not just concentrated in the semiconductor sector, in the semiconductor sector and AI plays. And then if this is true, we could really test the 100-day moving average. So if it just mimics how those sellers have done, we could be testing 100-day at 710. And to be honest, 710 is still pretty decent level. If you told me at the beginning of over here in January, and after this sell-off that we're going to get 710, even after a correction, that's pretty good year so far, right? So bear in mind that on average, the stock market returns 10% a year, but already we are 10% higher year to date after just 6.5 months. So a little bit correction really doesn't concern me that much, and to an extent, I think that's quite healthy. Washes out a lot of leveraged players to rebuild momentum towards the year end. And looking at QQQ, the Nasdaq 100, the range bound plays a bit more obvious because we didn't really quite make that new high again either. So we're here, I think, so we're seeing a new low pre-market here, and I think we are really going to approach the 100% extension of this S1A to complete S1B at the bottom of this range here. So I think touching 680 is pretty likely given the momentum down here. Interestingly, Russell 2000 is slightly different in shape. We actually topped a bit later in July instead. So IWM didn't rally as hard as SPY and QQQ after April, and it started playing a bit of a catch up. And now we are still not that far from the highs. And what I think is that we could be consolidating sideways. And if we follow the path of S1 and S2, S3 could test at least the 50-day moving average and also the bottom of this price channel. So I think semiconductor is really interesting. I think it's time to get a bit more cautious. So I highlighted here, this looks very much like a potential head and shoulders play. And we've had a neckline, if I just draw it a bit more properly, we've got a neckline just around here. And that was the previous high in May before we saw a little correction and then a move up to the left shoulder. So today we have broken below this support. So now this, the next target is really the 100-day moving around 670. There's not a lot of volume here, so it could travel down here quite quickly. And typically what you see is that if we do get a thrust downwards, this support becomes the new resistance. And I think it depends. So typically people are actually looking at 100% extension from the head to the neckline, which points to the 200-day moving average at 400. So that is a pretty sharp correction from where we are at the highest around 650. But it could happen in 3 phases instead of the straight down. So I think what could happen is we first test the 100-day moving average. We see a bounce towards this new resistance line, and then we see another sell-off. So it becomes a 3-leg sell-off into the 200-day moving average. I think that's the most likely path. Looking at IGV software could benefit from semis correcting because of rotation. So right now, I'm actually still leaning a bit neutral here. I'm just looking at this chart. I mean, a lot of people have believe this has bottomed, and we had impulse impulsive looking move up that broke above the 200-day moving average. But I didn't like the fact that it sold off straight away instead of trying to follow through a bit further. And we retested the 100-day moving average before bouncing off. The encouraging thing is that the trend is turning higher. So the 50-day is moving above the 100-day. So that's a positive development. But the price right now is trapped between the moving averages. So it's quite neutral. There's a chance that because we got rejected by the 200-day, we can turn down again and retest this area. So what I really want to see is a follow through move upwards above the 200-day, and my hypothesis is that if rotation does come in, we can test the 100% extension of R1. That will create a R2 rally 2 target of 123, and that is, I think, a new all-time high. So just above the September sell-off, and basically the reversal of the Sassacopoulos would have completed, and then transitioned into the semis downfall instead. Okay, looking at Bitcoin, so I've covered this chart many times. I don't think a lot have changed. We are testing the 50-day moving average, but we got rejected. So really the picture hasn't really changed that much. So sell-off 2, 100% extension of sell-off 1, and then sell-off 3 reached a 75% extension of sell-off 2 and sell-off 1. So it does feel a bit incomplete. We're still below all the key moving averages. I would actually say that the 50-day moving average is probably redundant right now, because how often it's been breached and then re-breached on the upside and downside. The real test is really the 200-day moving average. And as the moving averages start to come in together, basically the price we have to pay in terms of waiting and missing the bottom becomes smaller, because what could happen is that we start to move up, the price start moving up. If it gets rejected by 200-day moving average, so the rally is falsified, we just wait. But if it breaks above, which is not that far away from where we are, so 73K versus 63K, and then the moving average starts turning up and crossing each other, that's pretty, that gives us a bullish signal for entry. And I would actually prefer waiting for that reversal than getting my money in, hoping for this being the bottom and then getting it trapped until, let's say, late October, etc. So there are a few factors going for Bitcoin and ETH, which is, the cycles chart starting to turn up for them. But in terms of the technicals and my systematic signals, they are still pretty neutral and flat. So I'm inclined to just wait a little bit longer. ETH, again, we had it's hard to say whether there's a fake breakout yet, because we had breakout out of this range and then it sold off to retest, but we're just holding above this range right now. So the jury is still out. What I don't want to see is a repeat of this period here in March. So we had a breakout here that looked quite encouraging, and this could have been the bottom, but it was rejected before it reached the 100-day moving average. So we had a sharp sell-off back towards the 50-day. It moved above 100-day again, then it moved below 50 and 100 for the next leg of sell-off. So we've seen this pattern a couple of times already in this down cycle. And again, I'm quite keen to just wait rather than rushing in and hoping this is the bottom instead. Looking at MSTR, so the MSTR points very bearishly for me, and that doesn't sit me well for Bitcoin either. So this is a very clear head and shoulders pattern, and this head was more like a double top. And the price has broken below the neckline, and it recently made an attempt to reclaim this neckline resistance, and it failed. So now the path of least resistance is down here. And the worrying thing is that in terms of MNAV, so the price of the security versus the net asset is nearly par now. So it's not like we are squeezing air out of the premiums. Now this is really just moving with Bitcoin, also the confidence in Michael Saylor's strategy generally. So, and Michael Saylor has been selling Bitcoin to fund its stretch dividends, which is so he's got a few credit vehicles that pay 11 to 13% per year, but he has to fund them by selling Bitcoin or raising capital via selling his shares. And neither of them are great options right now in the down market and with very little MNAV premium. Coinbase, head and shoulders pattern again, but the difference is that it's holding above the neckline. So here it does look bearish, but I am being more neutrally inclined. It can still make a rebound and invalidate this setup, bearish setup. But if it breaks below the neckline, then I think we have to be very cautious. It's still below the moving averages. So again, not really keen to claim the bottom is in just yet. Robinhood looks a little bit different because, as I've shown you before, here each rally is very similar in size. So you have massive phases of rallies that triples or quadruples or almost up 5x, and then you have very steep sell-offs that unwinds about half the rally from the previous phase. And it seems like this actually could be a bottom if we can reclaim the key resistance here. So what's going on here is that we previously had a head and shoulders pattern, a neckline that was broken down, price moved below the neckline, below the 200-day moving average, very bearish. And then over here, we could potentially have had a inverse head and shoulders, and the price channel that's moving upwards, and also the 50-day moving average crossing above the 100. So these are all encouraging signs, especially with the moving averages. When the 50-day crossed the 100 before, those were confirmations of the new uptrend in all of the previous phases. So it does look different to MicroStrategy, looks different, and it looks different to Coinbase. The key here is basically we need the confirmation of this breaking above, and then we can target 300, which sounds like a lot, but it's done this sort of rallies before multiple times, and that puts us at 100% extension of R2, which is also the same length as R3. So just replicating the previous rallies would get us to 100%, get us to $300, but obviously we just need a bit of a confirmation. Alternatively, I think the way we could play it is when it retraces down here to the bottom of the channel, I think could be a tactical entry point with strict stop loss, and waiting for the mean reversal carrying it higher. Gold has been very sluggish. All of the sell-offs were equal length to each other. So this is a really nice pattern we see across assets in these type of rallies and sell-offs. So each phase is very similar to the previous phase. And I think this is probably psychological. So when it sells off this much in percentage terms, I think the market just basically sits and reassesses whether this is a tactical entry point, take profit. And then there's some people who are trying to play the counter trend. And then we see a nice little rally. But then when we get to, the key points like the 50-day moving average gets rejected and the downtrend continues. So I have been expecting a really relief rally, but it hasn't really played out just yet. But at the same time, we're still holding the June 24th low here, even if it breaches, is still around 100% extension. So we just have to see how it plays out from here. Again, silver, very similar. I think we're at a key support level. That used to be the resistance over here before the parabolic run. So I'm expecting some sort of relief rally that can target this high volume profile phase as well as the 100-day moving average. It hasn't happened yet, so we just have to wait and see if we get a breakdown of this support or we can get a rebound. Copper looks a little bit more bullish. It's carrying a broad uptrend. It hasn't fallen significantly from the highs And I think I'm fairly neutral here with a bullish bias. I think because it's not like we're trading at lows, but this support line has held so far. So I'm looking for the potential bounce for a new high and towards this top of channel run up. Looking at Max 7, so we had S1 and S2 in June, the equal length of each other that could have completed. That probably has completed because this week we've seen really strong momentum carry through and this rally back to high. So if we mark this as R1 and this as R2, what we see is that replicating 100% of R1 would give us a target of 350, and also this is a breakout from the channel. What we have seen previously is that when Apple makes significant moves like this, which has happened 6 times previously in the past 5 years, so 2.5 sigma move in one day, it tends to be range bound in the next 1 and 2 weeks, but in terms of a 3-month forward-looking period, it tends to average about 11% returns from the day of this breakout. So I think medium term, this is very bullish for Apple, but in the very short term, it could start consolidating a little bit or even retest this trend line. Amazon, I'm quite bullish on Amazon. I think we could repeat this rally here. That gives us a 320 target. So Alphabet is in this nice upward trending channel. So we overshot the top end of the channel and it's come back. I'm just a little bit concerned that this second sell-off hasn't finished. So 100% of the first sell-off gives us the 200-day moving average as the target at 320-ish level. And I think that's quite a natural zone for the downside. And if I'm looking at the volume since last year, we can see that, again, this is a high density, high volume profile region. And we should get a lot of support here. So I do think the 200-day moving average probably is a nice entry point for Alphabet. So Meta, we had 2 sell-offs from August 2025 that were equal length to each other. It seems to have bottomed here, holding above the trend line support. So if this is R1, then R2 at 100% can target 710. And if we carries through even higher, let's say to 150%, it could challenge the top of this channel. This is not uncommon to see. If we 150% extension of R1 in any wave terms, this will be like a powerful wave 3 after the bottoming phase of wave 1 up, wave 2 sell off. Microsoft, unfortunately, I don't think the chart looks that constructive. It's been saved from the lows here. So this neckline has basically been supported. But if you just look at in terms of the trend, we are in a downward bias trend, seeing lower high and also lower low over here. So it's not that encouraging. We're trading around 100-day and 50-day moving averages. To me, I need greater confirmation that this is not a right shoulder. So basically, I want to see a breakout from here. So NVIDIA had a very long consolidation period in 2025 to early 2026, and it had a rally with the rest of the semiconductor, but it stopped rallying quite soon, so in May. And I think the market is quite concerned about the prolonged the health of the AI cycle, but I don't think that's the entire story. It's more about the custom chips, application specific chips that a lot of companies like Google and Amazon and even Microsoft now are building that could challenge the monopoly of NVIDIA. So not everyone needs the expensive, high quality chips NVIDIA provides. And so there is a risk that NVIDIA could lose its market share. And also China has openly rejected NVIDIA chips as well. Now they prefer Huawei chips. So that big market is no longer open to NVIDIA, even if the export controls are uplifted. Just looking at the patterns here, though, we had a head and shoulders pattern that broke down, but we managed to find support around the 20-day moving average. We reclaim this neckline here. So that's a bit encouraging. That's constructive. But we haven't cleared this right shoulder here either. And it could be that I'm drawing this thing completely wrong, and this could be the neckline here, or this could be the right shoulder here. I think right now is not really easy to say just yet. With the broader semi sell-off, I really cannot rule out that actually this was, the neckline was downward tilting, and this is the real right shoulder rather than over here. So I'm in a bit of a watchful mood right now for NVIDIA as well, even though in terms of fundamentals and growth rates, it does look very attractive at these prices. Tesla. So Tesla really couldn't find a bid after or even before the SpaceX IPO. What we see is that this was a sell-off one, and this R1 with the two rallies that were equal length to each other basically stalled at 450 and couldn't carry through to a more turn into a more powerful rally that clears the all-time high. So here the risk really is this is a potential sell-off two, and to replicate the length of sell-off one, we might be seeing a target of 300. Is trading really carefully here in a very narrow range since June around the key moving averages, but we've tried to reclaim the 200-day, couldn't happen. So I'm not that constructive on it. AMD, so AMD is stalling near the 100% of R2A here. So this rally could have completed. We haven't broken down just yet. We're breaching the 50-day moving average. There's next support around the 100-day. Looking at the volume since March, there is a chance that this is a distribution zone here with very high volume, but unable to make new highs. So it could be shares changing hand to distribute. And then the real support really comes around the 100-day moving average at the 340. This could be a quite quick fall when it happens, but until it sees a breakdown, I would say below 440, the uptrend is still sort of intact. It's hard to fade it just yet. Broadcom. So Broadcom hasn't done as badly as the broader semiconductor in the past week. But my thesis was that S2 nearly completed 100% of S1, and this could have finished. But there's no clear evidence that R2 has started, which is why I've said this is a potential R2. We really want to see a breakout above the 50-day moving average. Then after that, we can really try to target the 600 mark. But before that happens, the price is a bit trapped. If we falls below the 200-day moving average, we can expect a steeper drawdown from here. So, broad scheme of things, I am overweight, but cautiously so. Marvel, I highlighted the risk that this is the head and shoulders pattern that broke down, and it has broken down, and it has moved below the 50-day moving average. Now, as I've warned on other charts, that once you cross below the 50-day average, the air below that is quite thin. So there's not a lot of support between the 50 and the 100 days. So even though that gap looks quite big, it could really just travel down here quite quickly, minus 7%, minus 8%, and today minus 4%, or even, give another minus 5%. We're basically here at the 100-day moving average. There's a little bit more volume here for support. Previously, there was a bit of a consolidation in the 170 region. So I think naturally, symmetrically, this could be the natural pause here, and some people could start trying to buy the dip. But otherwise, I do think this is probably the beginning of a downturn. ALAB, I didn't cover this one before, but just looking at the price since last year when it was listed, it's an uptrend, but very wild, volatile range. So I think here I'm probably a little bit underweight. It just moved below the 50-day moving average. Every time it hits down that, Jan 2025, October 2025, it proceeded to cross below the 100-day moving average also, and then 200-day moving average. So this does look like beginning of a downturn. I would probably wait for here the bottom of the range before I consider an entry. Just looking at the volume here as well, most of the volume is built around 100, which makes sense. This rally happened very quickly on slightly lower volume, but we could see 200-day as the main support here, and then 170 for this initial volume profile. Similarly, Credo as well, uptrend since 2022, pretty volatile, and it's just broken down the 50-day moving average. So previously, it broke down the 50-day, and we've seen a rebound, but this was more of a consolidation rather than a continued powerful rally, and soon after, we're seeing a downturn. So this could be a sell the rally regime after we've breached the 50-day moving average, which we have done here. ARM holding looking very much like Marvel. As you can see, past week, the price has broken down this support line here, traveled down to 100-day quite quickly, which could find the first support, but really the main support comes from the 200-day moving average and the top of this price channel. TSM, so TSM is broadly in the uptrend. Over here, R2 is very close to 100% of R1, and that has been a natural pausing zone we've seen elsewhere as well. So over here, I'm probably neutral. 100-day moving average is a critical support. So, and we're testing it today. So if it can really hold against here, I think the uptrend is intact. Otherwise, we could see a breakdown in the uptrend as well. SML, very similar. This R2 has reached 100% of R1, so that's a natural pausing zone for the rally. What we see here is that we're still holding above the 50-day moving average, so it's hard to fade it just now, but I wouldn't be surprised if we see a breakdown like TSM. Micron, so I'm comparing the sub rallies in this R3 powerful rally that started a year ago. So if we compare R3B versus R3A, that was 125% of R3A. And then R3C is 100% of R3B. So these two rallies were equal length. And the R3D is more stretched. So it's 100% of R3C. But interestingly, what we see is that when we reached the 100% of R3C, which is a typical sort of pausing zone for the rally, we saw a little retrace. So the market recognized that the run could get extended above here. So a retrace, and then the buyers coming in for this final thrust, almost a blow up top. And this 100% extension is also serving as the neckline support of this head and shoulders pattern. And that head and shoulders pattern could be breaking down today. So we're still above this high here. So giving the benefit of the doubt, I wouldn't say the uptrend is completely broken, but if we fall below this high here, we could be quickly testing the 100-day moving average, in which case the uptrend is definitely broken, and then I'll be pretty underweight when it happens. There's not a lot of volume in this region until 720-ish, so we could find some support around this region here. For Qualcomm, for me, this rally was already done a couple of weeks ago after breaking below the head and shoulders pattern, and this is quite a good case of assessing how head and shoulders break down. So typically what you would expect, like I said before, is that the sell-off from the neckline should be equal length to the head to the neckline. But we actually see is a three-wave downward move where we have the head to the neckline, we have a rebound to the right shoulder, and then a sell-off in the right shoulder. That's 100% replication of this initial sell-off. A rebound to the neckline again, which fails, and then another sell-off that replicates this second sell-off. So those three waves on the downside replicates 100% down decline from the head to the neckline. Texas Instrument, so in the range bound here, again, it's very much a head and shoulders pattern. It hasn't broken down, so difficult to fade it just yet. Intel, we are breaking below this previous low, so my concern is that we are seeing the reversal already. We're testing the 100-day moving average quite soon, and then after that, the 200-day is at 60. So that's quite a bit of an unwind from the rally that we saw since April 2026. Cisco, so I think Cisco has gone on a parabolic run. The price has broken down now, so we could be looking at a slightly more bearish outlook now as opposed to neutral. And what we see is that R2B has reached 170% of R2A. So this is a very big rally, stretched. Definitely not chasing here. And if anything, I would be probably slightly bearishly positioned against this trend. SanDisk. So what I want to highlight is that if you just look at its mesmerizing run since August, the 50-day moving average has served as a very important support. It's been tested a few times, always held, but no longer that is no longer the case now. So we've broken below the 50-day. If we lose the 100-day as well, that's definitely the beginning of a downturn. And given how far this has run, there's a lot of air and room for reversal too. CRWV, I think this rally was definitely a failed attempt. It didn't look impulsive, and now we're looking at potential sell-off too at 100% replication of S1. We're looking at 45. We've just broken below this trend support as well, so things are not looking too great. NBIS, so this rally 2, in honesty, is a bit short of a target compared to rally 1. So it only reached the 75% extension of rally 1. But the critical signal here is that I've placed a blue marker. Once we breach the 50-day moving average, we're entering a consolidation phase, just like we did here. So we're quickly testing the 100-day. So we could get a rebound, but overall, this is now the beginning of a consolidation pattern. And that took, from October to March, 6 months to resolve. We are only 1 month in. So even if someone is bullish in the long term, it might still be helpful to just wait and not get the money trapped in a brutal economic mean reversal regime. I just want to zoom out here. So R2 was 100% of R1 again, and then we stopped here. And then in the sell-off 1, we actually saw a double top, and then a lower high and lower low. again, this is a similar pattern. We've seen potential double top and potentially a lower low that could end around the low 20s to complete this S2. Unfortunately, we didn't have a breakout that I would have liked to see, but after the short-term breakdown of this head and shoulders pattern, I became quite cautious and I warned against the bearish path of visiting the 20s. Palantir, so Palantir I'm a bit neutral now, actually. So S2 reached about 80% of S1, but it's not clear that this is the end of the sell-off. It did reach the bottom of this channel, but the price on the rebound got stuck at the 50-day moving average. So potentially we could go for a deeper sell-off at the 100% extension at 95. Actually, that would be quite ideal for entry. That would give me a bit of a buffer, a bit of a cushion to peace of mind that S2 has sufficiently completed. But right now, to invalidate this expectation, we want to see a breakout above the 200-day moving average. Oracle, the chart looks quite bearish here. We've seen left shoulder, the head, right shoulder. Again, this is the pattern we've seen repeatedly. First sell-off, and the second sell-off could point to 97 as S2. And then what could happen is that we could have a rebound towards this neckline here, and then a final sell-off that points towards a much lower target. But for now, it's broken below the neckline. I'm very cautious. There's not a lot of volume for support either. So we've lost the volume. So we've lost the volume profile here. I'm just very cautious generally. So we're going to run through the software companies quite quickly here because all of them are still in a downtrend, but with a recent rebound that doesn't quite invalidate the downtrend just yet. So Salesforce clearly in a downtrend. We're seeing the potential 100% extension of S2 being 130. The price got rejected at the 50-day moving average, so it's not extremely constructive just yet. ServiceNow is probably an exception because we've managed to hold above this low here. So there's a chance that this is a new rally and we're seeing a breakout of the trend. So if this second rally replicates this one, we can see a test above 200. So if we break above the 200-day moving average, that's probably a confirmation that this has bottomed and we're in a new rallying phase. Snowflake is not clear that R2 has finished, but it is just slightly short of 100% of this R1. So I'm a bit neutral here, to be honest. Datadog, I do think this R3 is probably exhausted compared to R1, where 100% rally. That's also the same extent against R2. Intuit, I think the stock is probably undervalued, but technically it looks pretty much stuck in a downtrend still. We haven't even got back to the 50-day moving average. So if S2 replicates this S1, we can test 200. Adobe, similarly, I think is probably undervalued, but they don't have a CEO. So that transition period is probably going to be quite painful. The stock is in a downtrend. S2 has breached the 100% of S2A here. So S2B was 150% and S2C is 135%. So to get to 150% like S2B, that points to 178. CrowdStrike, R2B here has reached 90% of R2A. So 100% points to 235, but that's only 10% upside. I probably wouldn't chase. Similarly, Palo Alto, very similar in terms of the extent. R2 is approaching 100% of R1. So this is the breakout from the consolidation. So 100% will give us 400. So again, about 10% higher. I'm neutral. Net is an interesting one because Cloudflare has only breached above the 2021 high recently. And if you look at the sub rallies, so 1, 2, 3 are all equal length. So we likely have started R4 after clearing new all-time highs. So 100% of R3, which is also the same as R2 and R1, would point to somewhere in the mid 400 range. Fortinet, you've seen one chart, you've seen them all. R2 is 90% of R1, so pretty neutral here. Zscaler, so this one has broken out of its downtrend and retested and held. And if we're in an R2 rally, we could be testing the 200-day moving average. Netflix, so Netflix has reported earnings. The market is very disappointed. So pre-market today, we have broken below the head and shoulders neckline. Unfortunately, the bullish path is no longer there for us. And now we are looking at, so the pattern now is that we could have done a sell-off on here and a potential sell-off to at the 100% extension points to 62 level, which is not far away from where we are now. Uber in a positive uptrend by a very wide range, trading around the key averages. I'll probably lean towards overweight in terms of being tactically positioned for a mean reversion trade upwards. But if we lose this support level here, then we're opening the door to a much lower downside target. RKLB, so I've revised this chart slightly from the midweek. So we're seeing this R1 in 2024, and then the 2025 rally onwards in the R2 that reached 100% of R1. So we've reverted below the 200-day moving average. That's quite an important clue that we could have turned bearish here. So that 200-day has always held in this rally. We've lost it. I'll be very cautious. Finally, ASTS, again, head and shoulders pattern. We've lost that neckline and we've dipped just below this trend line as well. So again, very cautious. I think if we're looking at from this low here, we could have find some support around this region because of volume profile, but below that it gets quite dangerous. The next key support is in the 20s. So that's it for this week. I'm on holiday next week, so again, I'm going to miss the video. But I think in the future, from August and September onwards, hopefully mid-August, I will be doing more live streaming sessions around the market open. So there'll be more live content from me. So thank you very much. I'll see you in 2 weeks.